Paul Donovan from UBS's Global Economics Department. Never in the field of economic crisis has so little been done by so many for the benefit of so few. The G20 flew to Washington. They flew out again. In between, nothing happened. The statement issued was a bland recycling of previous policy announcements sprinkled with a selected collection of statements of the blindingly obvious. National governments were affirmed as the principal regulators of the financial system. Practically the only thing that the G7 can be said to have produced was support for the airline industry, with so many dignitaries flying first class to the United States. The fiscal stimulus from this use of taxpayers' funds was hardly optimal, however. The G20 was never likely to produce very much, not even a photograph with Senator Obama. Meanwhile, Dominic Strauss-Kahn of the IMF commented that the fund will probably spend around $100 billion over the next 6 months in bailing out countries in difficulties. As luck would have it, Japan has just handed over $100 billion to the fund. Strauss-Kahn was also suggesting that central banks need to cut interest rates a little further, including the ECB. In the real world, Japan saw third-quarter growth come in at -0.1% after -0.9% during the second quarter. There is much media excitement that this is an official recession, which shows how irrelevant the world is. There is no official definition of a recession, and in Japan, recessions are traditionally declared by the Cabinet Office. If growth in the third quarter had been plus 0.1%, things would hardly be much better for the Japanese economy. Monetary policy can do nothing for Japan. Fiscal policy could, but it needs to be the right sort of fiscal policy. Pork barrel construction projects are not the way forward. What Japan does have in its favor is the fact that it is not under pressure to deleverage. That was what the 1990s were for. The slowdown is cyclical, focused on exports, rather than the structural need for deleveraging. The UK's CBI is predicting growth for the UK economy of -1.7% in 2009. They're almost right. The UBS is predicting -1.8%, which is unnervingly accurate. The picture is rapidly becoming priced into financial markets and so should not cause a major surprise. The United States is offering industrial production today, and we get the lame duck session of Congress appearing this week. Neither event is likely to be immediately market-moving. We see industrial production bouncing back after the September strike and hurricane problems, and we have a 0.7% forecast. That is above the consensus, but the volatility of the data is being confirmed by the special circumstances. Away from the real world and entering the fantasy existence of the credit rating agencies, Fitch have noticed that A, there might be an economic slowdown going on globally, and B, this could conceivably affect the demand for cars. These astounding insights have led them to suggest that Toyota may have their rating cut from the current AAA. Normally, credit rating agency pronouncements are treated with all the respect that they deserve. However, there was something of a reaction as Toyota had intended to introduce 0% car finance in Europe, and at the margin, today's announcement may be a constraint on their funding of that. Finally, UBS have come out with a couple of research notes in recent days. Last week, we published a note on the euro explaining why breakup was unlikely, but that an expansion of membership was also undesirable. Today, we publish a brief summary of the G20's eloquent way of saying nothing. That's all for today. Have a good day.